Alright. So if there's anything on God's green earth that makes this small world of ours keep on turning, it's money. Money is the foundation of our society, and without it, we are absolutely nothing. And our mission as modern-day humans is to continuously generate money so that we can continue to live our lives in comfort. But at one point, I think we all begin to wish that our money would just work for us. And it's kind of funny to think about, but that can definitely be achieved through something called investment. Investment is basically the purchasing of any income-producing asset that can generate a profit on money invested in the future. And there are several different ways to invest your money, each with their own individual costs and benefits. And all these ways, they range anywhere from the stock market, bonds, ETFs, commodities, exchange-traded funds. The list goes on and on. It's completely endless. And each of these ways I've already listed are all diverse in their own strategy and profitability. But keep in mind, there's not one correct way to invest your money. And on top of that, don't take this as one way is more perfect than another. Every investment is a risk and should be considered as such before you decide on anything to do with your money. So don't paint me as some sort of expert that can tell you everything to do with your money, because I'm not able to do that. The balance reports, people lose money in the markets because they think investing is a get-rich-quick scheme. From 1997 through 2016, the average active stock market investor earned 3.98% annually, while the S&P 500 index returned 10.16% in returns. I believe this goes to show how investors don't always capitalize on how much they can make with their investments, and it goes to show how people don't understand the process completely well. So on top of that, let's jump into the most well-known of all investment, the stock market. So basically, a stock is a small piece of a company, and the stock market is where people buy and sell these small pieces of ownership. Now, these prices vary per company, anywhere from a couple of pennies up to thousands and thousands of dollars. And some of the companies you may know that are listed on the stock market include companies like Apple, Walmart, and Amazon, just to name a few. Now, there's mainly three categories that go along with investing in the stock market. This includes day trading, short-term trading, and long-term investing. Day trading is what all the big wigs on Wall Street like to do. They will buy and sell stock within one trading day. And this creates for a lot of fast-moving prices and increased risk because you really enlarge how much you can lose within just one day. Now, these day traders use what's called technical indicators to try and forecast where the price will go in the future, and these have garnered a lot of skepticism recently because they're consistently faulty and they don't always perfectly predict where the price will be in the future. According to a financial analysis journal, the speculator is generally unsuccessful at beating the market, but the results contain interesting information on frequency of trading and the possibility of certain groups of speculators outperforming the market. Now, moving on, short-term trading is more along the lines of what I do. So I will buy and sell, or I buy stocks and I'll hold them for a couple of weeks or a couple of months and I'll sell them. And this is a lot safer to do than day trading because I'm able to give the stock some freedom to mature and try to increase price, and I minimize my risk as I'm not selling the stock too quickly. Lastly, the long-term investment is the best of the three and should be sought out if you're going to do any type of investing. This way you can maximize the amount of cash you can get out of investment, and you put in absolutely no work at all, which is really great. One of the things that's coupled with this type of investment is called dollar cost averaging. Dollar cost averaging is basically, it's proven by investors such as Warren Buffett and Jimmy Graham to be profitable for years and years to come. Investors with cash destined for stocks employ dollar cost averaging by dividing cash into segments and committing to convert each of the stocks on schedule, states Meyer-Statman. So basically what that's saying is you take a portion of your income each month and put it into the stock market so that you can average your exposure in the market and minimize your risk. Now, moving away from the stock market, we're going to head into bonds. Bonds are probably one of the most safest forms of investment. For those of you who don't know, a bond is a promise to pay a debt or an IOU. So if I went up to Matt and I said, hey, you give me $100, I'll give you a bond. And every year I'll pay you interest on that $100 for X amount of years. That's basically how it works. So every bond has what's called a maturity date. And the maturity date is where the interest on the bond is paid in full. So after these range usually from 1 to 30 years. So after say 30 years, all the interest on that 30-year bond will be completely paid. And because some of these maturity dates range, there's a lot of variability with the interest rates. From an article about the danger of bonds, because the bond interest payment is fixed, the higher its price goes, the lower its yield becomes. Now, this is one of the main drawbacks with bonds, as it provides one of the safest investments, but with the lengthy maturity rates it has, coupled with lower yields, it requires a pretty patient person to try to get a good profit out of it. Now, has anybody in here seen the movie or read the book called The Big Short? Anybody? Yeah. If you haven't, it's fine, but it's about basically the Great Recession and the guys who predicted that it would happen. And so what they did is they engaged in something called shorting, as the name The Big Short implies. So Investopedia describes shorting as follows. Short selling is the sale of a security that the seller has borrowed. A short seller profits if the security declines. So the guys who predicted that the entire world's economy would just implode, they believe that they bet against the market. They believe that it would fall. They didn't think it would rise, it would probably fall. So when they were right, they profited pretty generously off of it. Now, short selling is probably hands down the riskiest strategy of all investing, and it should be taken with extreme caution whenever in consideration. And this is because your negative side potential is completely unlimited when you short sell. So basically, when you buy a stock, the amount you can lose is however much you have invested. But when you short a stock, the price can rise up to infinity. So if you lose money when the stock rises while you short, and so if it just keeps going on, you can lose money forever. But if you do have the guts to engage in short selling, the payoff can be tenfold from any other type of investment. And each guy up here on the screen, they made billions and billions of dollars just off of the financial crisis. Lastly, I'd like to discuss one of the more under-the-radar forms of investing called commodities or the futures market, which is basically investment in raw goods such as oil, silver, gold, coffee beans, corn, any type of raw good, and you exchange it in real time. These are also called futures because when you buy a commodities contract, you already look to sell it at a specified date in the future. So you already have a set date to sell it. This creates a lot of unprecedented risk because you don't know how much the price is going to change from now to when you're supposed to buy it or sell it. As reported by Business Week, although commodities may be bargains today, some 70 to 90% of investors lose money in a high leverage and volatile futures market. Now, based off of this quote, you can tell that this is mainly for those intense risk seekers who they love fast-paced action like that. And it's very uncommon to see individual investors engaged in commodities trading because it requires a lot of capital just to get involved, and the risk more than likely will outweigh the payout. In conclusion, there's no right way to invest, and there's never any certainty that you're going to ever make money on your investment, but there are ways that we can minimize our risk and maximize our profit at the same time. Warren Buffett once said in a speech, "I have an old-fashioned belief that I can only expect to make money in things that I understand." I really like this quote. I think it's great because it speaks on the idea that the more we understand about our money and how we can have it